There is a lot going on in the world right now. We're just coming off of a midterm contentious election. We have missiles landing in Poland from God knows where. We have crypto billionaires trying to escape the law, hiding out in the Bahamas, hiding out in Bali, losing the hard-earned savings of millions and millions of people as billions and billions of dollars are being expunged. But I don't want to talk to you about any of that. I want to talk to you about what no one else is talking about that is much, much more important to your financial health today and going forward. First, let me introduce myself. I am Bag of Dawn at StockMarketCaddy.com. Today is November 16th at about 11:30. And let me further say this. My wife Susan and I have been involved in the market since 1981. I taught surgeons how to do surgery for 25 years. Susan worked for the likes of IBM and for Lotus. Proudly, we do not come from Wall Street, thank God. We have seen a lot. We've owned stock before we owned furniture. We've experienced good times. We've experienced bad times. In the early 2000s, we set out to take control over our own financial destiny. It was not recommended by any of the so-called pros, so-called experts. We do not manage anyone else's money. We do not make specific recommendations to buy or sell a thing. 10 years after our endeavor of building objective, consistent algorithms, we developed what we called Stock Market Caddy. Stock Market Caddy is a mentoring site for those individuals who want to understand how the markets function and how they might function around those markets. We're not into storytelling. It isn't about the narrative. It is about money flow. What I want to share with you today is the interest rate structure, the yield curve, because it's critically important if you are in these markets that you understand what is taking place. This is our tool called Swing Machine. These symbols, this is the 13-week Treasury bill, the 5-year Treasury bill, the 10-year Treasury bill, the 30-year Treasury bill. These numbers here, the 90-day, it isn't yielding 41%, it's yielding, you move the decimal over, 4.120. So if you go to a bank, if you have $100,000 and you go to a bank and you say, I want to buy a 13-week Treasury bill, the bankster is going to pay you 4.12% today on an annualized basis. And you might say, well, I'd like to get more, Mr. Banker. What if I give you my $100,000 not for a 90-day commitment? What if I give it to you for a 10-year commitment? And the banker says, okay, we can do that, but your yield is going to be 3.731. And what are you going to say? What the F? You mean to tell me you're going to pay me 4.12 on a short-term basis, 90 days, and you're only going to pay me 3.73 if I give you a 10-year commitment? And the bankster is going to say, yes, that's the deal. You see, the yields on the 90-day paper started to rise 220 days ago. When? Back on January 4th. On January 4th. Now, if you go back and look, the peak in the stock market this year, the peak was when? January 3rd. Why did the rates rise? The rates started to rise because the Federal Reserve was increasing the short-term interest rates. Why would he do that? Because we had inflation, not just asset inflation, but we have food inflation, as you've been reading and hearing about. Now, the inflation rate is admittedly over 8%. Many people, learned people, will say that the Federal Reserve is in an impossible situation because unless this interest rate gets above 8%, above the inflation rate, he can't stop the inflation. But they think they can. In December, he's going to increase the short-term interest rates another 50 basis points at least. This short-term interest rate, the market thinks, is headed at minimum to maybe 5, maybe 5.5, possibly. Now, why is this important? And what is this line showing? This line we programmed years ago, because we understood this relationship. It plots the difference between the 90-day yield and the 10-year yield. When it's flat to up, there's a certain group of people that absolutely love that. The banksters. Why? Banks borrow money from the Federal Reserve and from each other on a short-term basis, and they loan it out to the sheeple to do whatever they want with it. Start a business, hopefully, speculate in the markets, speculate with cryptocurrency, buy fungible tokens, God knows what. Back here, these yields on 90-day paper were like at 0.00 something. They were very, very low. The yield on the 10-year was also low, but the differential was steep and healthy. The banks produce nothing, but they make their money when these rates are low and these rates are high. That's how they make their money. When the Federal Reserve increases the interest rate here in an attempt to quell inflation, which we don't know if he's going to be able to do that, the banks have a hard time because money now is very expensive to them. And you may see the interest rates on the 10-year going down, and the interest rate even on mortgages start to go down. And you might draw the conclusion that that is good, and that is a sign of a healthy economy. We're going to say no, it isn't. What the banks will do is when the interest rate is high on the front end and lower on the back and they can't make any money, they will tighten their loan restrictions. Back here, when it was wide, they would loan money to anybody that could fog a mirror. When it peaked and started down, they start tightening credit restrictions. And that's when we find out who's been lying. There's an old saying, when the tide goes out, you find out who's skinny dipping. We're learning today that we have some fraudulent companies, some fraudulent exchanges. That story is probably going to expand. You see, when the yield curve is nice and wide, the banks are not too concerned. They're going to get their money. But when it's inverted, it's tougher for them to make their money, and they become more stringent. And that's when the frauds get exposed and the economy begins to slow. What I want to draw your eyes to is right here. Do you see how this line went negative? That's when the 90-day yields crossed over the 10-year. This is a marker that we're headed into a recession. We haven't had one for years. There is an economic recession dead ahead. We're probably in one now. There is an iceberg. The economy is going to slow. We don't know how bad that's going to be. In some time, it may be months, it may be years, the Fed hopes they can retard the inflation, and they hope that they can slow the rate of these, and this line will begin to head back up and start to widen out, and the banks will begin to loan money, and the economy will restart. These words, by the way, were not printed by me. They were printed by the computer. You see, we wrote this program years ago, and when that line crossed right here, it printed automatically for us and for our members, negative dynamic yield curve, economy stalling. So be careful. The markets, stocks do not like recessions. Things in the past that were speculative, stocks where people were not doing their due diligence on valuations and just throwing money at money because things were going up, that won't be the case during a recession. I'm Bagadon at StockMarketCaddy.com. If you're interested in getting an objective, consistent view of the markets, of money flow on a nightly basis, you're welcome to join our monthly club and see what we're about. It's month to month. If you would like to have this tool, as well as 70 other proprietary algorithms monitoring the markets and your stocks in the privacy of your own home office, our annual members get the very same things that we have, and more valuable than any one of the 70 and growing tools that we use is the instruction that goes with it. More than welcome to call me any day. Can be during the week, can be on the weekend, 9 a.m. to 9 p.m. I'm happy to speak with you. I wish you the best. Months, years from now, but months from now, we will and you will know that we went into a recession back here. By the time the press starts reporting on the recession, it will be well underway. It very well may be coming to an end. But it doesn't have to be in months. It could be a year or two. But you'll remember this video, and you'll remember this date. From our point of view, the recession started right here. November 9th, 2022. Good luck, everybody.